Hi, welcome to the video today. It's the 23rd of July and it's Sunday. In today's video, I want to look at trading big fundamentals. Now, in terms of trading big fundamentals, there's one at the moment that I think is really important in terms of the global economy. It's a slow up in China. China's powered global growth since 2008, but it's slowing up, and that slow up is going to continue. That's going to have an impact in terms of the FX market. So I'll look at five pairs in relation to the slow up. The first one is going to be the USD against CNH, so the offshore spot Chinese yuan. Then four countries that are really exposed to the China slow up. Three commodity currencies. They're going to be AUD, NZD and ZAR against the USD. And then finally another country, not a commodity producer, but Singapore, which has big trade links with China. So we're also going to be looking at USD SGD. Now, in terms of the China slope, it started and it looks set to get worse. It's a big fundamental. I don't think it's going to be turning around anytime soon. So we're hoping we're going to get big trends in our favour in the FX markets against the slow up. Now, what we're going to do is look at the slow up in China in more detail, go through the key levels of support and resistance. But just before we do that, if you want to learn all our trading techniques and check out our daily technical sentiment analysis of 14 FX pairs, all you need to do, go to the link beneath this video and get live access to our member center. You can also check out a couple of articles in relation to China, link beneath this video as well. You can then, if you wish, join our Facebook group of traders and follow us on Facebook as well. Right, let's take a look at the pairs and the slow up in China in more detail.
All right, let's have a look at what's going on in the Chinese economy. And I've started my first chart here, which shows sort of shows forecasters' views of the China or Chinese economy going forward. Now, this is reopening after COVID late last year when restrictions were lifted. Majority of forecasters saw really strong growth ahead, okay? Up here, 4 out of 5 forecasters were very bullish on China. Now it's only 1 out of 5, and with good reason, really. If we look at this chart here, headline CPI inflation is come to the 0 level. Core is not far behind. The GDP deflator is in negative territory. So China has deflation, which could actually end up in a recession. Export markets have dried up because the global economy is slowing, and domestic demand cannot make up for the fall in exports. Domestic demand is weak. Here you can see industrial output down. This is from May, but June was a similar picture. So industry not doing well. Retail sales, consumer, they were down as well. What about imports and exports? Exports, you can see a nice fall there. Imports turning down as well. And then you've got employment, and it's in particular young people can't get jobs. So near enough 22% or over 20% youth employment. And then you've got debt levels really, really high. Official general government gross debt here above 80%. IMF augmented public debt, they've got it up above 120%. Now, this rules out big stimulus. A lot of people talk about China doing massive stimulus to get the economy going. The Chinese know debt levels are so high now, they just can't do that, okay? So if you look at what's coming out of China in terms of statements, the government authorities are lining people up or warming people up to the idea that there's a bit of austerity or hard times ahead. One of the major problems in China is the real estate market. It is the most important market in the world. Look at the size of it. China housing. You can put US stocks on top of US housing. They're still smaller. Put the bond market in and you'd only be a bit bigger than the Chinese housing market. Now, you go read this article for yourself, but keep this in mind. 70% of household wealth in China is stored in property. It's worth 60 trillion, which is 30% of China's GDP. That's how China created really great growth numbers, by building, okay? That now is not happening, and you've just got a housing market that basically is going down. Housing investment, housing sales, housing starts in 2023. You had that little brief move up there, but we're really going a lot lower. Okay, this is transaction volume 2023. You can see transaction volume down. Previous years 2019 to 2022, we were quite strongly up. Property related activity growth, floor space sold, new starts, completions, all down. Okay, so that is a major problem for China. The housing market just really not in good shape. Maybe we could see a crash. It is a big bubble. Okay, but even if it doesn't crash, yeah, the SARP will continue. China will struggle. Domestic demand is just not there to pick up what is being lost in exports. Okay, so yeah, hard times ahead for China. That means a stronger USD against the Chinese one, and also lower commodity currencies. Let's go and take a look at the charts. Right, AUD USD monthly chart first. This is really just to see our targets. You can't see them on the daily chart. Go over to levels of entry, stop and target in a moment. Now here, November boost for the Aussie dollar from below 64 to above 70s. That's a sizable rally. Rally ends into the 20-month moving average. Another rally recently seems to have ended into the 20-month moving average. Where could we go to on the downside? We've got the 64 level here. And I think, you know, in terms of this level, we need to first take out 65, then 64 will give way. So 65 there. Then we should run 64 longer term. I think we'll go down to the double bottom I've just highlighted here. Global economy, in our view, is in worse shape now than it was back then. Okay, so if our view is correct, that's 61.20. You'd be looking at a 600 pip decline. Okay, if you wanted to trade this pair, how would you play it in terms of entry, stop and target? Let's go and look at the daily chart, and for the rest of the charts I'm just going to use the charts from our member center. Right, let's go and take a look at the levels. Right, AUD USD. Now in terms of this one, you can see that we're just coming in to the 67 level. We're already short. You can see our position. We're looking for this level now, hopefully to give way. If it did, you could come in with the same stop as us if you wanted, just back from the 68 level. Look for follow through to 65 and then 64, then obviously run on to monthly support. Okay, now in terms of, let's say we did flick up and our stop was taken, it's tight behind the 68 level of course, then all we do, sell back through 68 and your stop could be behind 69. You've got two tails and two bodies close up here, then a tail there. I think the 69 level will be really hard to take out, so it could be taken on a break lower or on a failed rally higher. Now in terms of the next pair, NZD USD. Right, NZD USD, you had this big surge to the upside there, and then we reverse, we get in at 63.50, and it's a couple of hundred pips to the downside, but there's far more downside to come in our view. You can see what we're looking for. New daily lows, monthly support levels 58, then 56, so about 550 pips more to our target. Now in terms of this one, it's moved a little bit more aggressively than the Aussie. What you could do with this one, I think, is, you know, if we opened, you know, similar to where we closed on Friday, I would sell. I think the stop should be at 62.70, so behind the second level resistance. If we do see a bit of a retracement above 62, that will also take out the 20-day moving average. So I'd be inclined to wait for a break back below the 62 level to come in short. I mean, hopefully we don't get stopped out. But if we do, we'd be looking to key off this big level up here, okay? Hopefully we just continue to the downside. USD ZAR. This one has had a really nice correction. Big correction there, then a rally, then another correction.
We've already come into this one at 1805, and we've slipped back below our entry. It came in above this resistance level, obviously. Now, in terms of here, I think that's an exhaustion tail on the candle I'm highlighting. We're blue. Okay, we're off the high, but we're still holding the support level here. So another move through there. Look for follow through to this target here, then follow on. This is a very volatile pair. It is an emerging market currency, and I think obviously what's going in China affects South Africa, but also if we get risk on coming into the markets, that tends to really hurt the emerging markets. We don't have any at the moment, but that could give the dollar a boost, but I think the dollar is going up anyway. Now, in terms of USD, SGD, right, in terms of the USD tops out there, that's a big fall on the SGD. Exhaustion candle there, the red, that's the confirmation candle, the blue exhaustion, get back above 132, and now we're heading north. Now, in terms of my page, I put target chart highs. I'm going to extend that up to monthly resistance at 138. So how would you play this one? I think you could come in above the high, 133.20. Stop initially behind this level here. You can see our stop. Then if you get a nice blue, you can just pull it up behind this level. Pullback should be held by these two bodies here, 132.50. So yeah, move to chart highs, then on hopefully to monthly resistance. SGD is not a commodity currency like the other three, but it is heavily exposed to what goes on in China, obviously a big hub in the Far East. So yeah, that's our view of China, what's going to happen going forward and what could happen in terms of the commodity currencies. So we'll see what happens. We'll update these pairs in future videos, but that is the video for today. Hope you found it useful.